This is the first episode of a new mini-series where I'll be taking the covers off the subject of diversification in trading. This is an immensely important subject and, if done correctly, enables an approach to better control your overall risk exposure and to allow you to put all that hard work you've already invested in developing a trading strategy to optimal use. And so it would be really great if you could take this journey with me for the next 10 episodes, and I hope you're looking forward to it as much as I'm looking forward to delivering it. Stay tuned. Before I start, I'd just like to say a huge thank you to everyone who expressed their thanks for the last series that I delivered on the subject of indicators. Now, based on the comments, I know that a lot of you wanted that series to go on for longer, but I felt that it was probably time to change topic. When it comes to trading, there are so many areas of knowledge that we have to understand, and so many different skill sets that we need to develop, and indicators are just one part of that. So although I will probably return to indicators at some point in the future and get into that subject in a lot more detail, for now we're going to move on to a new subject, and this is a critically important subject, that of diversification. So without further delay, let's make a start and see what's in store for the next 10 episodes. So at the beginning of any series, I think it's worthwhile taking a look at the journey that we're going to take and the subjects that we're going to cover. So today's episode is going to be an introduction to diversification and look at the fundamental reason why this is a good idea. I'll also look at a specific but simple example of diversification in action so that you can see the great potential of this technique. And then in the next episode, I'm going to look at the question of whether diversification is the golden bullet or not. And by this, of course, I mean, is this the answer to all of your risk-based issues? And I will give you a little bit of a hint now that the answer is no. However, as you see when we go through this series, it's a fundamental part of that. Next, I'll start looking at some of the practicalities of achieving diversification in real life. Following this, I'll start to look more specifically at the ways or mechanisms that you can diversify and look at 4 of these over 4 separate episodes. In the episode that follows, I'll be looking at the concept of whether you can have too much diversification, and is there a point in which this loses its value. Then, a really important subject, that of balancing risk across this diversification strategy and the portfolio of techniques that you're using. And then finally, we'll finish up by looking how to measure correlation between different assets in order to inform your own diversification strategy. So hopefully you're looking forward to this as much as I am, so let's get started. So the first thing to note really is that diversification isn't anything that's specific to trading. In fact, it's a concept to consider in other areas of life also. So for example, a financial advisor might recommend that you spread out your investments. So the whole concept here is about not putting all of your eggs in one basket. This means that when one particular investment is maybe suffering, others are hopefully doing well. And then at other times, vice versa. So based on this, you might have investments, for example, in property or pension funds, maybe longer-term stock market investments, or money sitting in the bank earning interest. And this probably isn't my kind of thing, but maybe you also want to invest in art or fine wine. And clearly, in terms of how you go about this, you need to think about this and consider it yourself, and potentially get some financial advice from an independent financial advisor. But in this series, I'll be tackling the subject of diversification specifically in trading. And I'm going to be covering all of what I consider to be the important concepts and options in order to undertake diversification in a practical way, for you to then go away, explore and research those for yourself, enabling you to make your own decisions on your own diversification plan. So what is it that makes diversification such a valuable technique in trading? Well, the first point is that it's a mechanism to reduce your overall portfolio risk exposure and to smooth out drawdowns. Now, pay particular attention to that term, overall portfolio risk exposure. We're not talking here about managing the risk of individual trades. This is on the much wider portfolio basis. And based on smoothing out those drawdowns, means that you can also smooth out the returns. And the whole principle behind this, of course, is that when one trade is suffering because of maybe a market move against it, hopefully other uncorrelated trades are still performing well. And again, pay particular attention to the word uncorrelated. This is particularly important when we talk about diversification. And the effect of this is that the overall returns and risk across your portfolio of trading approaches should be smoothed out, if done correctly. But determining the specific rules that will actually reduce the risk can be more challenging. And of course, this is one of the topics that we're going to be covering throughout the series. And so based on all of that, we can now put together a concept for diversification in trading and summarize that as follows. Diversification is a technique that contributes to lowering the overall portfolio risk, enabled by the trading of multiple uncorrelated techniques. And one of the most powerful ways of illustrating this is by looking at an example. And as I said before, I'm going to cover 4 diversification techniques in this series, but we're just going to start off by looking at an extremely simple example of one of those. So in this example, we're going to look at 2 assets, Euro-Dollar and Aussie-CAD. And the reason I've chosen these is because they tend to be relatively uncorrelated, because we're using 4 different economies as the basis of these. Now clearly, if I'd chosen Euro-Dollar and Euro-Yen, then there'd be a higher level of correlation because they both have the Euro component. But by choosing 2 currency pairs in this way means that they will have a more uncorrelated nature. And I'm going to start off by illustrating a trading strategy that assesses both of these for risk separately, but then move on to the concept of trading those 2 as a mini portfolio to see what impact that has on the risk. So let's start by looking at Euro-Dollar. Now, a quick explanation of the chart. The blue line is equity from the backtest, and whenever equity makes a new high, you can think of that as a high watermark. So the watermark remains flat until the equity makes a future high, in which case it follows the equity up. And then the grey line represents the risk tolerance. So think of this as your tolerance for drawdown. And this of course will be different for different traders because everyone has a different tolerance. So some traders will feel comfortable with a 10% drawdown. Other traders might feel comfortable with a 15 or 20% drawdown. And that's something that you need to consider and decide on for yourself. But because percentage drawdown is always based on the high watermark, that's why this line follows the same pattern as that. Now, one more thing to note before we move on. This has been on the basis of a 1% maximum risk per trade. So by that, I mean 1% of the current equity at the time the trade is opened. And using that level of risk, you can see that the equity curve remains within that band. And so it's within the tolerance of this particular trader. It never exceeds the 10% line, which of course is what you should be aiming for based on your own risk tolerance. So now let's move on and have a look at Aussie CAD. So here, clearly the pattern is different and the drawdowns appear at a different point in time. But equally, we're still within that risk tolerance. Now another thing to note is that each of these systems is trading both long and short. As you would expect with a currency pair, there's no reason to just trade in one direction. And so now looking at those two charts together, we can see that the major drawdowns suffered by each actually appear at different points in time. And that's what you would expect from two uncorrelated assets. So for example, with euro dollar, the main drawdown appears here at the end, where it probably reaches somewhere between 7 and 8%. Whereas with Aussie CAD's actually doing quite well during that period of time. Here, the drawdown appears more towards the centre of the equity curve, and that is exactly where euro dollar is doing well. Now in terms of the specific metrics, you can see the compound annual growth rate for each at the top here, so 4.5% and just over 6%. But the most important metrics for this subject that I want to concentrate on is the maximum drawdown, which for euro dollar is 7.7% and 6.9% for Aussie CAD. And then to combine these two figures into a single quantifiable measure on how well each system is performing, we can use the CAGR over maximum drawdown performance metric, which of course takes the reward, divides that by the risk element to give us this single figure. So we've got figures of 0.57 and 0.89. Now let's move on, and instead of trading these separately to get separate equity curves, we're now going to combine them together into a mini portfolio. And this is the resulting equity curve. So the first thing that you'll notice here is that the overall drawdown has been minimized. It's also worth noting that for this, I've reduced the risk per trade, because clearly in this model we may well have multiple trades open at the same time, and so I've halved the risk per trade. So now by looking at these three equity curves all together, we can see the difference this makes. And looking at this in a quantifiable way, we have euro dollar on the left hand side here, Aussie CAD is in the central column, and then the mini portfolio of trading both of those is in the right hand column here. Now because I halved the risk, the CAGR value ends up being somewhere between the other two, which is exactly what we'd expect. But look at the maximum drawdown figure. This has been significantly reduced. So we're now on a 3.8% drawdown. And by combining that with the compound annual growth rate, we get a figure of 1.38. And this is the value of diversification. We've taken two separate assets. By combining them into a portfolio, we've reduced the level of risk and we've improved the reward to risk ratio. And if we look at all of these equity charts side by side now, we can see that with the orange line, which is Aussie CAD, and the blue line, which is euro dollar, there's a lot more volatility in the equity curve. The red line that sits in the middle is the portfolio of the two assets. And I think you'll agree this is a far superior equity line. And just as a reminder, across all three of these systems, we're trading both long and short. So hopefully you found that a valuable introduction to diversification. Next time we move on to this question of, is diversification the golden bullet? And in actual fact, look at the reasons why that isn't the case. Now, if that episode is already released at the time you're watching this, then you'll see it top right now. If not, remember to subscribe and give me a thumbs up. And now until next time, trade safe.